I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views, which you can find online at cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
Tim, I've noticed the NASDAQ and the S&P once again in record territory. We've talked in the past about we're in a big bubble. How big is the bubble, and how did we get here?
Jim, it is an ongoing bubble. There's no question about that. I actually had some questions about the big picture bubble. So I guess, let's it's been a while since we've talked about that background stuff. Are you okay with us going through that and,
absolutely.
kind of paint that picture?
That's not a problem.
Well, you have to paint the entire picture, you have to go back into the 70s and 80s and into the 90s. And, that was a real organic, if you will, I don't know how else to describe it, bull market. No question about it. The tech bubble was very real. I worked at the time in the cellular world when cellular was first coming on for a major telecommunication company, and all that was very real. And when I say real, I mean organic. It was a real bull market. It was driven by not only rising prices, but, a sound underlying economy and expanding volume within the market. And that said, we moved into the top in 2000, which I remember at the time a lot of people talked about, anticipated that top. I say anticipated it, and I don't think many anticipated exactly what followed, but they anticipated a slowdown because of all of the Y2K stuff and, this kind of the dot-com bubble, and there was an anticipation of a slowdown that turned into the decline into the 4-year cycle low in 2002. But in conjunction with that downturn, something happened. Number one, the volume characteristics of the market changed, and I'll come back to that in a minute. But going into that top, and this is an old chart that's floated around the internet for a few years now, and I haven't seen it recently, but then I don't pay a lot of attention to this sort of stuff that's floating around. But the velocity of money, we've talked about this before. It peaked in 97. I'm looking at a chart, and, it started kind of forming a divergence into the stock market top, the real organic economic top that occurred in 99-2000 time frame. Prior to that period, going back, I'm looking at the data going back into the 50s, you had generally rising, you had within that 70s, 80s, 90s period, I talked about the real organic bull market. Yes, you had some downturns in the velocity of money. You had some recessionary periods, but they were just that. They were recessionary periods. And looking at the velocity of money, the overall trend during that time was higher highs and higher lows. And so you had corrections along the way. And then as you moved into the late 90s, the late 80s, early 90s, it just went parabolic. And that's when, the economy was literally on fire. And like I said, a very healthy economy. And then, to support that, if you look at, the labor force data, it was the same way through the 70s and the 80s and into the 90s. It was pretty healthy. It started to kind of flatten out in the late 90s, and it also peaked in 2000. And so that kind of gives us the underlying, pulse, if you will, of the economy. In 2000, the stock market peaked, and I had made the call based on that top and some cyclical statistics that we should go below the 98 low, and we did. In the process of going below that low, the volume characteristics, and this is just basic technical analysis. It's been a while since we talked about this stuff, but the basic characteristics of the market changed. And what I mean by that is that in the secular bull market period, the real secular organic bull market period, as price rose, volume rose, and then the corrections were seen with decreasing volume, and then you'd come out of that correction. For example, even going into the 1998 four-year cycle low is a pretty healthy correction. I don't know the percentage just looking at the chart as I talk here, but it was a pretty healthy correction. We had declining volume, and then as you came out of that low, volume expanded again. So it was still bull market behavior. But after the 2000 top, that changed. Volume began to wane as we moved into 2000, and then it began to expand as we moved into the four-year cycle low in 2002. And then as we came out of the four-year cycle low in 2002, that's when a lot of the monkey business began in trying to, I guess, bridge the gap and keep the economy going. Volume continued to decline. And as those Band-Aids were applied to the economy during that period, we did see a little bit of an upturn from 2000. I'm looking at the charts from 2004. Finally, it got a toehold in 2004, and we saw a little bit of a push up into 2000, and looking at the chart into early 2000, January 2007, with the labor participation rate. So we did get a little bit of a bang for the buck in the underlying economy there. And looking at the velocity of money, it made a low. It came down hard out of a 97, 98 top, and then we got a low in 2003, and then we got a little bit of a push up into 2005. Then it began to roll over. So we saw those efforts to rekindle, if you will. We did see some results with those underlying factors. But then they rolled over, and then it created, the extended, an extended four-year cycle top in 2007 in the stock market, which resulted in, people have forgotten all about it, I think, but the worst financial crisis since the Great Depression. We had, as a result of those efforts, we had the commodity bubble. We had, everybody's forgotten about peak oil and, 140, whatever it was, $47 oil or whatever it was, and everybody thinking it was even going higher. People have forgotten about, the housing bubble then, I think, by and large, and that, stocks were, they were pushed to a new high in the bubble there, and I said, based on all those fabrications and a lot of statistics and cyclical stuff, that we should move below the 2002 low, and that it was only making matters worse, and that proved to be correct, and we did move below that low and into the 2009 low. And from there, things really heated up with, trying to, again, bridge the gap, for lack of better words, and rekindle the economy. Yet, that time, we saw less and less bang for the buck, if you will, with the underlying economic indicators, if you will, the ones that to me, that count. Coming out of the 2009 low, we saw an upturn into, I'm looking at the data, July of 2010. That's all we got, a slight uptick in the velocity of money. And since then, it's just continued to crater. When you look at coming out of the 2009 low, in let's see, let me look at the chart here. Coming out of the labor force participation rate, it was barely a tick up, and then it's just cratered. The last year, it's kind of flatlined, but it's still at levels not seen since mid to late 70s. And all the while, looking back at the velocity of money, it's at the lowest levels going back to, since the inception of the data that I have in the late 50s. The stock market, on the other hand, they've done a masterful job, granted, of extending this market. We had the extended push into 2015. It finally resulted into a very minor, one of the mildest 4-year cycle declines in history. On the industrials, that low occurred in August of 2015. Almost everything else, it was either January, February of 2016. It was an enormous bubble then. It's even a more enormous bubble now. Looking at, as we came out of the 2009 low, compare that to what happened coming out of the 2002 low. Commodities did not participate or have not participated to the degree that they did then. Looking at gold, we had a very nice move in gold coming out of that 2002 low and into the 2008 high. And, this time gold, it participated a little bit. We got the top in 2011, and we've been down ever since. So housing, yes, housing has also participated, but I don't know. I don't have any hard data to say, yeah, we're back to the same levels that we were back then. I think there's some data that suggests we are, that the bubble is back. I know looking at, someone was telling me about an article about real estate in Canada and in California, the number of houses over $1 million and that sort of thing. And so that suggests that, yes, the bubble is back there. I know in my area, real estate is on fire. Technically, are we back to the same levels that we were in 2007? I don't know, but I would argue that we're probably close.
We'll have more with Tim Wood right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Welcome back. We're speaking with Tim Cyclesman Wood, our overall subject, the big bubble picture. Tim, why did this happen?
Well, I don't fully understand. I know why, but I don't know why. I mean, the reason it happened, I think, was simplistically an effort to try to negate the downturn out of the natural top that had occurred in 2000. I mean, this has been an ongoing battle since 2000. The organic, I hate to use that word, but it's a good word. It fits. The secular, if you like that word better, the secular top occurred in 2000. And it's been an effort to negate or bridge the gap between, the downturn of that cycle and the resumption of a new cycle, if you will. And it's kind of been a catch-22. I mean, you try to bridge it and it doesn't work, and so you try a little harder and it doesn't work, and you try a little harder, and next thing you know, you have no choice but to continue to do what you're doing to try to fix the problem, and it's just a hole. And I think that they found themselves in a hole trying to fix the problem, which has created an even worse problem. And, the stock market, I started out saying that, and I know this sounds crazy, and maybe it is, but I started out saying out of the rally out of the 2002 low that it was a bear market rally. Well, that actually proved correct. We did, the market moved back up basically to I think it made a slightly new high and then cratered into the 2009 low and moved below the 2002 low. And I argued that was a bear market rally. And, I still stand by that. I think that it was. And then coming out of this, the 2009 low, I said that was a bear market rally, and here we set at a new high. And so that sounds crazy to say. How can it be a bear market rally when we're at a new high? I guess it depends on if you want to put, I don't know. I'm not trying to pick my words or justify my position or anything. What I'm trying to say is that it's a fabricated rally. How about that? It's not organic. It's not real. The economy's not on fire. I was there in the 90s, and I know. And this is not that environment. You know that. Everybody else knows that. And so, okay, we're at a new high, so I guess from that perspective, yes, we can call it a bull market, but when we look at the package and how we got here, it's a non-organic, non-secular, fabricated bubble. And from that perspective, I'm saying it's a bear market rally. And when I look at the volume characteristics even today with the market at the levels that it's at, and some people want to justify that away, and you really, I haven't found a good argument for that. I said, well, it's the ETFs. No, I have not found anyone that can give me hard data to justify these volume characteristics, and they didn't start today. They've compounded over the last 17, 18 years. So this isn't anything new. There are problems that are ongoing here. And so, yes, I think that it's definitely a bubble. And as I was talking, I pulled up a chart of the Philadelphia Housing Index. We're virtually back to the same levels in 2005. So I guess technically the bubble there is back. And so what I'm saying is that everything pretty much has, collapsed together into the 2008-9 lows, and then everything has pretty much advanced out of those lows, some to varying degrees. Housing, like I said, is almost back to the old highs. The stock market obviously has surpassed those highs. Commodities did not, and we had the rally in metals into 2011. They've since collapsed. Commodities have not, in general, participated to the same degree, and so we're seeing relative weakness there. And now here we sit, and I like I said, I know it's a hard concept to grasp, but I think that it is the bubble of all bubbles, and I think it ends like any other bubble.
We'll have more with Tim Wood right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Tim Cyclesman Wood. Tim, if we're at the height of all bubbles, where do we go from here? What happens to things like housing and gold?
Well, first of all, let me say this. Until we get the proper technical setup, and we will see it. I mean, it's going to happen. We saw back in 2000, I was able to identify that top. And with statistics, doubt theory, and the cyclical structure, at that point, I think because the market was more real, if you will. Once that setup fell in place, the market took care of itself. It did exactly what it was supposed to do. 2007, it had some help staying up, I think, and that's what extended the cycle. But then even we got the setup, and pretty much, boom, it come down. In 2015, we got the setup finally, but we didn't see much downside, and I think that was because of outside forces trying to possibly hold it and prop the thing up. I mean, that's not conspiracy. I mean, come on. Everybody can see and knows that. And now here we sit again with this latest push. And I said that to say this. I think there's no question in my mind. We will see, based on doubt theory and other factors, we will be able to see an indication of the top once that occurs. Until that occurs, hey, I don't know. Like I said before in other shows, there is data that I have that says this could be 1927, in which case this latest push is not over, and the point being is that there's more of the parabolic advance left, or this could be 29, and we could see indications fall in place pretty quickly. I don't know when those things are going to happen, but I'll know it when I see them. And so until that happens, hey, it can continue on. Once that's in place, then I think there is a real danger that a major top is in place. How that affects everything, I think it's going to affect housing. I think it's going to affect everything, just like it did in 2007 and 2008 and down into the 2009 low. I think everything goes down together. I think gold. I've been saying that the advance that we have seen coming out of the lows in 2015 and 16 were counter trend. We've seen some counter trend rallies since, and I still stand by that. The same thing with oil. I think there's a further weakness there, but then once those lows are made in gold that I'm looking for later this year, originally I thought it was going to be right about now that the major low was going to occur. Markets are fluid. I'm not making excuses. I'm now looking at November. But I have said that the longer-term 9-year cycle low, ever since the 2011 top, would occur in the 16-17 time frame. And I said in 2016 that was not it, or 2015 at that low. I said that was not it. It was too early. The 2016 December low, I've said that was not it. It's too early. It's counter trend, and I stick to that. I still think there's a washout with gold. But then the good news is for the gold bugs, and I know there's a lot of gold bugs out there. I know there's a lot of enthusiasm about gold. And like I said, I find it funny, but I had an email a while back said I was a gold hater. That's kind of comical. But no, not at all. I think there's the washout, and then I think there is a tremendous opportunity with gold and in gold stocks once we get that final low. And I think that what the cycles are telling us, that why that opportunity is there, I think what that cycle is reflecting is the negativity and the bursting of the bubble that we see in the other asset classes. So anyway, long story short, yes, there's opportunity in gold, but not yet. As for housing, I think it's another disaster coming. I do.
Tim, what does this mean for bonds?
Jim, I think that there's also, a long-term top trying to form in bonds. In other words, maybe you want to call it a bubble there as well, but not yet. I think it comes after the fact. We had, I believe, in my work, it was a long-term, a 3-year cycle low. There tends to be an ebb and flow of approximately 3 years in bonds, and we had that cycle low, I believe, in March. And so bonds are poised now to move higher. And I think that is also reflective of the trouble that bonds see in equities and other asset classes. So the flight to safety, if you will. And then I think that once that push into that 3-year cycle concludes, then I think the bubble in bonds burst as well.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views, which you can find online at cyclesman.com. You're listening to HowStreet.com radio. Any questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.